gold is overextending itself at this point here. And if you have a deflationary bust that I'm talking about, the recession, and you will have bank crisis, you will have, there will be a lot of, trouble around the world and liquidity wise as well. Gold will not do well. So I'm expecting a major low to come in miners, in silver and in gold when you see the recession sets in. And actually, you had that in the financial crisis as well. And right now we are seeing exactly the same kind of, development before the financial crisis. Gold fell by 33%, I think it was, from March of 2008 until September 2008. 6 months, it fell 33%. And I think silver in the same period fell by 60%.
The price of gold is currently facing selling pressure near the $2,050 mark, which is attributed to the positive state of the US labor market, which has reduced the likelihood of early rate cuts by the Federal Reserve. This week's gold market experienced its first decline in 4 weeks, shaped by a mix of US economic reports, Federal Reserve policy prospects, and currency trends. Gold ended at $2,045, marking a drop of 0.84%, while February Comex's futures closed lower by 1.06% at $2,049. Market expert Henrik Zeberg from the Zeberg Report emphasizes gold's significance as a crucial asset during crises, especially in times of liquidity shortages, serving as a means to acquire US dollars when necessary. Gold has shown remarkable resilience historically during periods of inflation, demonstrating consistent price increases amid such economic climates. Its stability as a commodity further bolsters its attractiveness as a long-term investment choice. However, Henrik is cautious about purchasing gold at its current valuation because he anticipates an imminent deflationary downturn. He foresees an economic scenario leading to a liquidity crisis where gold might underperform. The present market environment poses challenges as investors seek to hedge or diversify their portfolios with safer assets. While gold is considered a protective asset amid market uncertainty, Henrik refrains from buying at current levels because he expects a deflationary downturn that could trigger a liquidity crisis. Despite gold's recent strength surpassing the performances of silver and gold miners, there is a possibility that it might be overextended currently. He believes that in a forthcoming scenario of a deflationary downturn and recession in 2024, gold might not perform well due to heightened financial turmoil and liquidity challenges. We will present clips from Henrik Zeberg's interview with Soar Financially. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
See, I am a gold person myself. I am a gold bull also, but in the long term. At these levels here, I just don't want to buy because, as again, a natural consequence of what I'm saying here with a deflationary bust is that there will be a liquidity crisis. And the reason why people hold gold, and they don't really consider that, the reason why you want to hold gold is when you have a liquidity crisis, gold will always be your way to get, liquidity, meaning US dollars. So gold is a good thing for that. And also long term, because when you have inflation, it moves up, gold will, follow in price. And it's a, the same and stable kind of, product commodity. So I am a gold buck also bond, but I'm still standing with the 1250, where I maybe moderated it. It's because of the, I have to say, gold has stand out strong here for the last couple of years. If you look at silver, it never stood out as strong as that. If you look at the gold miners, it never stood as strong as that, which are indicators to me also. And if you look at that, normally when you have a strong gold market, a gold bull market, you would see that silver and gold miners were actually leading gold. You haven't seen that for the last couple of years. So I think gold is overextending itself at this point here. And if you have a deflationary bust that I'm talking about, the recession, and you will have bank crisis, you will have, there will be a lot of, trouble around the world and liquidity wise as well. Gold will not do well. Why would you want to go buy gold if you need to pay off your bills? You need to pay down your debt levels and your debt. I think there is a misconception again about why I'm calling for this. I mean, I'm not anti-gold or anything like that. Actually, I'm the opposite. I think the next monetary system that we are probably going to see at some point will be based on gold. So I again, because I think that's a sound way of having a reserve currency or a reserve basket currency that is fixed to something. So we just can't keep printing money. The call is because of the deflation that I see, of course, of the recession that is going to set in 2024, as I see it, and into 25. But the moment when we get the Fed coming back in again, we get, when they try to push or to inflate the economy again, that's the moment I'll be one of the first buyers of gold. But again, please note also, if you look at the gold miners, which is actually my main play here, is the gold miners have been declining. Also, I think they are way down in 23. I mean, they were down a lot by since June or something like that. I haven't followed closely just the last month here, but they so I'm expecting a major low to come in miners in silver and in gold when you see the recession sets in. And actually, you had that in the financial crisis as well. And right now we are seeing exactly the same kind of, development before the financial crisis. Gold fell by 33%, I think it was, from March of 2008 until September 2008. 6 months, it fell 33%. And I think silver in the same period fell by 60%. So I'm not against gold, and I think that's where I've been, misunderstood. What I'm just saying is that when you get that deflationary bust, you don't want to hold. I mean, if you want to time it, you don't want to hold, precious metals. You don't want to hold commodities at all. And we start to see that. You start to see, oil's been down. People are also calling for oil prices to move up. I had a call also that's saying, I think oil is going to come down from here. If you go back and actually right at the top there, and I'm saying we were going to see oil below $10 now. I mean, that's another call you can keep me up to next year.
I'm writing that down right
because
now.
when the recession starts, yeah, write that down. Let's take a look at it, and people will not believe that if we get to it. But the problem is that when the economy comes to a more or less of a standstill, despite of what the Fed will do, you need the economy, the real, people, the consumers, and so on, to be the ones that are actually carrying this through. And nobody expected a negative price in oil back then. I mean, so let's just say that people cannot understand it and they do not see it right now. It's not the same as it cannot happen, because we've seen, extreme situations like that.
The US corporate bond market is expected to ease its pace next week following a bustling start to the year. This slowdown comes after a day of varied economic data on Friday that dampened the likelihood of an interest rate cut in March. Henrik predicts a significant drop in US bond yields, especially the 2-year rate, a trend that has been rapidly declining since October, signaling an imminent and severe economic downturn. Recent months have decreased inflation to below 4%, with unemployment maintaining a historic low of under 4%. Furthermore, the economy recorded nearly 5% growth in the third quarter, which has set the stage for the Federal Reserve to shift from rate hikes to potential rate cuts. Interestingly, the Fed's recent meeting notes highlight a shift in focus away from discussions about a recession. Notably, the term recession didn't appear in the minutes from the central bank's last 3 meetings spanning September to December. Henrik criticizes the Fed's recent rate hikes, claiming they overestimated inflation. This move might pose challenges, potentially steering the Fed toward combating deflation instead of inflation soon. Let's get back to the interview.
Strong negative impulse on inflation in 2024, and I expect negative inflation rate of coming up to 5, 6, 7% at some point. And I know this sounds, strong, but that's what I believe is what we're going to see.
No, okay. I was going to talk about a couple of inflation trends as well, or also what the effects are of a 2% inflation rate. What would that mean from an economic policy standpoint? What will the Fed do? I think that leads us a bit to that Fed rate cut or hike discussion here as well. Market predicts up to 7 rate cuts next year, which I think is quite aggressive. The Fed itself and Jerome Powell announced maybe 3. They hinted at 3. Where do you stand on that, and what kind of impact will that have?
I've never been good at understanding and forecasting the Fed's rate cut cycle, what they do. But what I again, because I follow the economy, I don't follow the Fed. I don't see the Fed as a leading indicator on the economy, as many people do. What I look at a 2-year rate yield, U.S. yield, that is going to plummet. And it's going to plummet faster than what we saw before the financial crisis. And if you look at the first 2 months here, since the October top, we actually see some of the strongest declines in the yield level, market yield levels in US 10-year and 2 years and other yield levels than we've seen before. And this is an indication of the severity of the crisis that we're heading into, and which is also supported by the leading indicators that I follow. And what the Fed does, I mean, they will follow the 2-year yield level. That's what they normally do. So when we see a top in that, they will follow it down. not the other way around. So if you ask me what the market seems to be, what would happen in the market, I think we're going to see plummeting market rates. And when we talk in a year's time, so let's say, please invite me in January next year, market yields will be down to the lows of what we saw before the spike we saw here in yields. It's going to be really a tremendous drop here over the next 12 months. I think bonds will be a fantastic place to be in at this point here, because the recession, I don't see how we can get through 24 without seeing the recession. I mean, there are so many indicators that it's going to come, and but also that again, it's not here right now, but probably in 6 months' time, things will be a lot different. Recession will be the moment when yields really starts to plummet. That's always been the case. And the moment you see the recession set in, that's where yields are just dropping really hard. And yes, the Fed will follow there. So will it be 3? I don't think it'll be 3. I think it'll be more. But depending on, again, when the recession sets in and market yields. But they should be already at this point here, if they should really be front running the market and the economy, they should have understood long ago that what they did with the latest rate hikes was an overextension of what they needed to do, because the market dynamics was already pushing inflation down, and it was clear. I mean, there are so many indicators of it, and I said it even on my live shows. I said I think this was not just 1 or 2 bridges too far. I think it was 3 or 4 or 5 bridges too far. They got scared of their own ghost that they thought they have created in an inflation ghost, not understanding, and this is really shocking and surprising to me, that the real economy is what drives inflation. The real economy is supply and demand. And if you're going in and you're boosting the economy monetarily and fiscally, fiscal stimulus into a supply crisis, well, then you're going to get inflation. I didn't expect it to move that high. I'll be fair to say I didn't expect inflation to spike up to 9%. But what I think the Fed was thinking that they did was that they, through their money printing, actually had created this, and now they wanted to really get it down again and get the genie back in the bottle, and that's why they went out and went so hard on inflation and rate hikes. But I think it was a way overextension of what they needed to do, and this is going to haunt them in 24, late 24, and into 25, because they will be fighting deflation soon again.
The upcoming week holds significance for gold traders due to key economic reports affecting the Fed's policy. Despite a modest loss in value, many analysts view the gold market's performance positively at the outset of 2024, as it consolidated within the range of $2,000 to $2,050 per ounce. How does the recent dip in gold prices impact its role as a safe haven asset in uncertain times? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel and turn on post notifications for more videos like this. Thanks for watching.